Welcome back, everybody. Thanks for joining us today, along with Alex Jamieson from AJFinancialPlanning. Good to see you, mate.
Thanks, Greg. Great to be here.
It's been a very busy time, I have a feeling, and I'd like to start today with someone who's been around for a long time. He's 97 years of age, name is Charlie Munger, and along with Warren Buffett, who's 90, by the way, they at Berkshire Hathaway, over the last more than 40 years, have brought a return of over 2,000 to 1 to the investments, and they look very much at longer term strategies. Well, Charlie Munger is also a director, was on the board of the Daily Journal, and he's been very critical about the Robinhood trading platform. Now, this is what Charlie says: short-term focus is harmful to one's wealth, particularly when chasing popular momentum stocks. Now, Robinhood, the platform, they have an app that offers no-fee trades, and they've caught the attention of millions over the last year. While Charlie and people like him are very critical, the Robinhood people say they are missing what is a cultural change. So what do you say to that?
Yeah, I think it's an interesting. So Charlie's sort of comments at the Daily Journal were really centered around this, or his concerns around the gamification of this app is really inducing people to gamble. And so they're no longer investing, they're day trading, and they're hugely speculating. They're turning on the app and seeing which are the biggest movers in the day, and that's the one I'm going to pick up and trade for today, and I'll sell it out by the end of the day. And when we look at day trading, there's a central belief that the more exertion that you exert, you should be able to get a higher return. So if I'm working incredibly hard, I'm day trading every day, my return should be significantly higher than someone that's lazy and doesn't do anything. The thing when it comes to investing, that's often not the case. And there was a study that was done by a group, and they looked at your probability of failure. So when you're looking at the investment landscape, you're really looking at, okay, I want to set up to win. So, I look at the fundamentals, I look at the broader market. And to some degree, you're also making an assessment around probability of success. Is this company likely to succeed? And you're wanting to be operating in levels of probability that, I guess, gives you a bit of a chance to be successful over the longer term. So if we bring up this chart here, this one looks at the 1 year sort of probability of success and I guess your probability of failure as well. And you're at around 31%. You've got a 70% chance of being successful. You've got a 30% chance that you're going to lose money. If we look at the top line, which is the 1 day, you can sort of see you've got a 46% chance of failure, and you've got a 56% odd chance, 54% odd chance of being successful. Now we know the coin flip's only 50%, so you're trading on somewhere between 4 to 6% if you're in the bell curve and if you're half reasonable. And Charlie's been around here long enough that he knows that the probability of these young investors that are coming to these investment platforms are probably sitting well off that bell curve, and their probability of failure is more closer to 90%, I suspect.
I think they'd have to worry about their mental health, these day traders, as well. It sounds like a very frenetic lifestyle.
To be honest, I couldn't think of anything worse. We find when we speak with clients that are interested in day trading and embark on the occupation, if I call it, they're horribly moody people to be around because their mood is linked to the relationship of the share market. And so, there's certainly a big mental element aspect of it. And look, you're up against some huge challenges with it.
Last month, we talked about the market potentially pulling back. Well, the NASDAQ in the US has dropped in value since you made that call. So where do we go from now?
Yeah, so we're really just waiting for the ratification of the US stimulus bill in the US. There's a lot of talk in the market that's going to be much bigger than what they need, and potential some risk with inflation in the future around that. Our expectation was sort of around a 6 to 12% drawdown. Various markets have moved at different paces. At this stage, we still feel there's a little bit more left to go in this. Certainly, our area of risk still remains open on the downside for at least the next 2 weeks. And we'd expect to see some further softening. As I said last month, though, we we would be really happy with this drawdown, and we're happy with it occurring because it's certainly stabilising the market, stopping it getting too frothy. It's clearing out a lot of those Robin Hood traders, which is great because they're all day trading, and people are getting a little bit more back to, I guess, rational sort of economics. And so once the pullback completes, which we would say should be in the next 2 to 4 weeks, certainly we'll be on level footing to sort of move forwards with the course of the year.
What about home loans, the owners with mortgage rates? To fix or not to fix? That is the question, is it?
Yeah, absolutely. So the bond market's often not wrong, and so it's often right. Their ability to forecast recessions in the past, they've called most of them well in advance with the inverted yield curve, and we've talked about that in prior sort of updates and the merits of it. The market at the moment is pricing in certainly some interest rate rises in the back end of this 10 years. And so we're sort of seeing about 2% being priced in the market at the moment. I think it's really for people that have a fixed rate or have a home loan, I should say, and they're looking at the mortgage and saying, hey, look, can I afford another 2 to 3% in interest costs on this mortgage? If they're looking at it and saying, yeah, no problems, that at the moment that looks like it is what it will sort of peak at. If they're looking at it saying, I'm going to be in so much trouble if this goes up, they're probably going to need to make some difficult decisions around it because it's likely, from year 3 onwards, we'll see some increase in interest rates. I think it would be worthwhile having a chat with your bank or a mortgage broker and start to sort of look at the landscape of what those fixed rates really look at around that 3 to sort of 4 year sort of period of time. And if they look really particularly attractive, coming out of a recession, typically banks do offer favourable deals to lock in their customers so they don't go elsewhere. It may be something you consider. Now, I'm not saying fix all your home loan. You can fix portions of them. And there's trade-offs that you need to speak to the bank or the mortgage broker about of what it might mean. But it's certainly a conversation that you probably want to start thinking about because, as I said, after year 2, we'll start to see potentially interest rates start to prop up.
Okay, so what can we expect with interest rates at the end of this business cycle?
Yeah, so the RBA will be chasing somewhere around 3%. They're going to need to have around 3%. So at the moment we're 0.1. They'll need to increase them by about 3% to handle the next downturn. Now, they've been really vocal and said, as I said, they're not going to make any moves for the next 2 years. So most of that heavy lifting will come around year 3 out to the end of the decade. But essentially that's sort of the figure. As I said, at the moment, they've only priced in about 2% in rise. But with interest rates, once you get the bear out, it can be a tricky one to sort of manage. So it just depends how much. If they keep putting more and more stimulus into the US system, then certainly it can be a challenging one to sort of handle once it gets out on the run.
Okay, what about JobKeeper? That's coming to a close. What do you expect to happen next in the local economy?
Yeah, I think there should be a fair bit of nervousness around the end of March. If the government is going to completely cut it and go cold turkey, so to speak, on the stimulus, this early reports are sort of talking about different things that they're looking at. But if they go cold turkey, we'd expect to see a pop-up in redundancies and unemployment numbers on the back of that. A lot of the sectors that were hardest hit, they were just purely running on stimulus money and still to this day. And if that gets cut, certainly see that. I think the other thing that we're looking at from a quality of employment perspective too, sort of the figures that we're seeing reported, someone that has lost their job is possibly not getting re-employed at the same sort of income levels as well. And so that's just meaning too, from that standpoint, their capacity to spend and all those things from an economic output perspective is not quite as robust as what it was before COVID sort of hit. So I think we'd probably see in terms of consumer sentiment numbers, particularly from April through to about September, people will be a bit nervous about the landscape and what the outlook might look like.
Can you just tell me about the Phillips curve, what it is? What's it all about?
The old sort of idea is this supply-demand, so economics 101, I guess, in terms of if you did an economics course, the first thing they sort of talk about. And the central banks sort of had this idea, if they could get unemployment to a particular level, and in the past it's sort of been about 5%, you should start to see some wage inflation, so people's incomes go up. And it's along the logic of, there's not a lot of people applying for jobs, so I've got to pay my staff more to keep them and not go elsewhere. What we're finding, though, is that 5% floor is actually not pushing up inflation. We saw it just before the last downturn. We got really close to it and no inflation to be seen, and really been chasing it for the last decade or more. And so there's some questions, I guess. There's two groups of thought with the economists. One is, hey, look, that number is a lot lower. There's a lot more excess capacity in it, so it might be 2 or 3%. And the other school of thought is, hey, look, technology is disrupting at such a fast rate, we're never going to see those big bouts of inflation again too. Why is it important? Well, I guess it's that inflation beast again, and what that might mean. A lot of people might remember in the 70s, those double-digit interest rates. We're not sort of forecasting anything like that. As I said, it's a 2 to 3% sort of interest rate. But certainly when something gets on a bit of a run, they can go a lot longer or a lot further than what people expect. And so that floor, when you're sort of picking up the newspaper and thinking about that unemployment number, what that might mean to your home loan rates, that would be an interesting reference point.
Well, let's leave today looking at two opposing views about inflation. Now, Janet Yellen was the former US Federal Reserve chairperson. She's now the US Secretary of Treasury. And she stated, although most Americans apparently loathe inflation, Yale economists have argued that a little inflation may be necessary to grease the wheels of the labour market and enable efficiency-enhancing changes in relative pay to occur without requiring nominal wage cuts by workers. Now, John Maynard Keynes was a little scathing. He stated, by continuing the process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of the citizens. Now, sometimes the balance is at either extremes, and we've heard today there are different viewpoints. The one thing for sure when it comes to inflation is it's important to keep pushing forward to avoid your wealth being eroded. Great to see you. Thanks for joining us. Thank you for being with us, and look forward to catching you next time. Bye-bye. The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.